Hey, and welcome to the session, Greg. I'm very excited to have you on today. For all of you, Greg and I have run into each other at a few SEO and entrepreneurship related conferences over the last few years. Sadly, not last year. And basically, he's part of the Empire Flippers team, and they help you sell your business. And I'm specifically excited to have him on today because they also sell SaaS businesses, and they just developed a new model on how they evaluate these companies. And I thought for everyone here starting a company, maybe thinking about selling a small SaaS company, this is going to be really, really helpful. And he's going to explain what to look out for and how that entire process really looks like. And so with that, Greg, over to you to tell us how the selling of SaaS business really works.
Awesome. Thanks for the introduction, Viola. Yeah, I'm excited to be here. Like you mentioned, there is some new updates to how we do it, how we help SaaS entrepreneurs sell their business, and just in general, I feel like there's some misconceptions of how to go about it as well in the community. So I'm happy to help, and hopefully it's going to be valuable. So I guess I'll just go on into the slides.
Yeah, jump into the slides.
All right. Let me put this in present mode.
Yep. All
All look
right,
good.
slides are running.
All right. So let's dive into it. And at the end, we'll do some Q&A, and hopefully I'll be in the live chat as well when everyone's watching this to answer any questions that you have as well. So how SaaS valuations really work. So first off, Viola did a great job describing who we are. But if you're not familiar with what we do, it's exactly what you said. We help people buy and sell online businesses. So that's e-commerce businesses, SaaS businesses, obviously, and content businesses. Those are the three main ones, but we sell others as well. We've had the honor of winning the Inc. 5000 5 times now for fastest growing company in the USA, and we sold over $300 million worth of deals. And it's not on here, but we now have a buyer network with a verified liquidity of $4 billion, which is pretty nuts. And that's only like a fragment of the kind of buying power that's really in the industry to buy quality businesses like what you are building with your SaaS. But all of this means that we have basically become the largest curated marketplace in the world when it comes to buying and selling businesses, which leads into who I am. I'm the head of marketing, so I lead the marketing team. But what I really do, the most important thing I do in a lot of ways, is I help educate the markets about the potential they have with buying and selling, because this is a what I call a highlight event in an entrepreneur's life. This is not something you're doing every single day. Even if you're a prolific business seller, it's probably an event that you do maybe every 2 years, maybe four. So it's not something you're in the trenches with all the time. And that means there's a lot to learn and often not a lot of time to learn it when you are trying to make an exit. So that's what I do. I help people educate the market. So if you are building your first SaaS project, say you are starting up your first project you've ever done, or maybe you're well in your way, you might ask, why would you ever sell your SaaS business in the first place? Like, one of the dreams of SaaS is that beautiful MRR that's coming in every single month, right? So let's talk about this, because there are quite a lot of reasons. And over the years of having sold close to 2,000 businesses, it really boils down to two main categories why you should look at selling, and that's personal and business. Now, the reason why I'm talking about this instead of going directly into evaluation is because it's very important to understand your reason for selling. Because if you just sell for the money, then you're going to have something that we often term entrepreneurial depression, which is, oh, I just sold my SaaS for $4 million and I'm over the moon for a week. And after a week, you start asking yourself, well, what do I do now? And you start feeling listless. You start feeling unsure of the decision, maybe even regretting the decision despite the life changing income it gave you. And this is more common than you might think. So that's why it's very important to understand your reason for selling. And ideally, you should never be selling your business because like you're timing the market or something along those lines. Should really only be selling if it's tied to a personal or business goal that you have, and ideally both. So let's talk a little bit about these. So we have the very negative stuff for personal stuff, divorce and medical. This is stuff we have seen. On a little bit more positive notes, we've seen people sell SaaS businesses or college funds, funding dream vacations, And these are typically going to be like your side project SaaS businesses. Those are the type of SaaS businesses that sell for these kind of reasons typically. Some of the bigger ones is obviously retirement, buying a home, and all that good stuff. Obviously, this is not an exhaustive list, but this is just to get the juices going for you to brainstorm your own personal reasons that might make sense. Business, similar to the divorce of business, the partnership breakup, right? This is something we see unfortunately happen with SaaS businesses at any size, really. It can happen at any size, whether it's a $200,000 SaaS or a $5 million SaaS. Partnership breakups could be a very heavy thing. Another thing is loss of focus and passion. In the SaaS startup world, it's not terribly uncommon to find ourselves programming several different projects and starting up several different small software companies. And it's not unreasonable to think that eventually you're going to become, you'll lose your focus, you lose your passion in one or two of those projects. So you're really dedicating all your time over here to a project that you believe just has a lot more potential. And when you get to that point, it's usually a good idea to sell. A lot of SaaS owners think like, oh, because it's not growing, I can't actually sell this small side project, so I'm just going to let it die while I focus on my bigger project, right? I would not advise that. There is a very hungry market for stable SaaS businesses that are profitable. It doesn't just have to be a revenue growth play, but we'll talk about that in a second. Another reason is mitigating risk. If you're in the startup world, in the SaaS world, you're very familiar with our good old friends, the VCs, who can pump capital into a competitor that wasn't a competitor until they got that money. And now they are really taking market share from you, right? As a bootstrap SaaS entrepreneur, this is a huge risk. And most entrepreneurs I know have the vast majority of their net worth in their business. So this is a potential existential risk in a lot of ways, right? So selling a SaaS business to mitigate that kind of risk, that kind of competition in the marketplace is a big reason for selling. Finally, oh no, not finally, but these two are kind of interconnected. Is capital for other projects and investments, and seed money for acquisitions. If you look at Empire Flippers, our repeat customers tend to be the buyers because it takes time to build up a new business to sell, right? Well, a lot of our sellers, once they do sell a business, they'll use that money to go and buy businesses from us. They'll buy smaller businesses that they know that they can scale, or they'll go and start other businesses that with now an actual marketing budget. They actually have a runway to grow their business, which is something that is kind of unusual for a lot of bootstrap entrepreneurs, which you probably relate if you're in that, trying to get traction phase with your business. And of course, retirement, it can be just as much of a business reason as a personal reason. So let's look at a seller's journey. So it really starts with your business idea, right? Then you create your MVP, you roll it out, and if all goes well, your profit starts to build, right? As you grow, your profit steadies, and then you sell, and then you redeploy the capital. This is a typical journey of an entrepreneur, right? Very basic, very, very clear cut. And that leads into this simple valuation formula. And a simple valuation formula is just your average net profit, say over the last 12 months, and times that by a multiple. And you'll see this is a valuation for an e-commerce business. And this is pretty standard. This is normally how it is done. But if you're a SaaS entrepreneur, you probably see the problem, right? What you're looking at on that last slide over here is a net profit valuation, which SaaS businesses don't technically need to play by these rules. Now they can, and we'll get into a moment where this type of valuation actually makes more sense. But we're going to get into the the stuff that SaaS can do that other business models can't really do nearly as well. So SaaS businesses aren't based on profit. And like I hinted at, they're really based on growth and revenue for most of their valuations. Not all, but many SaaS businesses can get a revenue valuation, and it's going to skyrocket the actual valuation of the business. So for a SaaS, the valuation formula looks more like this if we put it in very simple terms. You have your annual recurring revenue, and then you also have your growth taking over the same spot where your net profit would be. And so you're looking at that average ARR as well as that percentage of year over year growth. And so you can have a SaaS business that is completely unprofitable, but it is generating revenue and still get a killer valuation for what you have built because of the way the SaaS business model works. So let's dive into the actual multiple. What goes into that part? Because ARR/growth, that is, while not as easy to figure out as with net profit, it's still pretty easy. It's pretty simple to put some spreadsheets in and forecast. But the multiple is really where kind of the secret sauce lays of all the goodwill of what your brand has built that is going to help you get a better multiple or maybe a worse multiple than a competitor in your space. So let's first talk about these ingredients real quick, just so we have some clarity. But the revenue valuation that I just showed is you only can get this revenue valuation if you can show you're growing year over year. If not, then you'll be back at that profit valuation I talked about with e-commerce businesses. Now, this is very important for me to bring up twice. This is why I brought up on the slide, just because a lot of SaaS owners, they might have a business that is either super steady, has not grown in years, so it's just like a side project, or one that is declining. Maybe it did have growth and now it doesn't, and their profits are declining. In those kind of situations, it is very rare you're going to get a revenue valuation. You still could, there might still be buyers that would do it, but most buyers will be looking to price you on a more of a net profit valuation because you're no longer a growth asset, right? You're a profit asset, you're a cash flow asset in that sense. So you'll get a different valuation. Now, revenue valuations are better. So if you can make it happen where you can get that year over year growth and show that increased ARR, you're going to get a much better valuation. Another thing I want to talk about here is ARR versus MRR. So I was underneath this impression a long time ago when I first started doing articles about SaaS, and that was the idea that MRR is actually more valuable than ARR when it comes to your valuation. This is kind of true, but not really. Really, ARR is better. So I'll walk you through my line of thinking. I used to think that MRR, because it's something that comes in every single month and it's more stable, it was a better metric for your valuation than looking at ARR, because ARR could be wildly unpredictable, right? Like 80% of your customers signed up in June. Next time June rolls around, what's going to happen to 80% of your customers? Are they going to re-up, right? So after working in SaaS for a while now, I realized that for a lot of SaaS investors, they don't really look at MRR in that way. They don't find it more unpredictable by any means or anything like that. In fact, they're primarily looking at ARR, and they love you having ARR. So say you had a product that is $100 a month, and you sell a year's worth of that, and just say it's $1,200. Keep it simple. You'll probably want a discount of some sort. That is actually counted as MRR in the sense of how they do the accounting. But the ARR, the actual like collecting that annual fee up front, means you can put more cash, more inputs to generate more outputs, right? Whether it's Facebook ads, SEO, all that kind of stuff, which to them is very important because that's how they view SaaS, is these growth engines, right? So the more ARR you can collect up front, the more chances you have to put fuel into the growth engine, right? So ARR is actually better than MRR in that sense. Another thing is churn. So this is something I see a lot of SaaS owners really focus heavily on, and it makes sense. It's easier to get a customer to pay again versus go out and get a new customer. So churn is a logical place for us to focus a lot of our attention on to reduce, right? And I think there is something to be said about reducing churn and making that an active ingredient into grow your SaaS valuation for obvious reasons. But you don't want to fall into this trap where churn becomes all important, because while that is important, growth is more important. So getting new customers, new market share, all that kind of stuff is very important. If you just focus on churn, that means you are not doing growth activities most likely, and that means you are leaving a vacuum in the marketplace for someone to go and do those growth activities. And maybe they have worse churn than you, but because they're doing those growth activities, when you have someone that churns, guess who's waiting to pick them up, right? The person doing those growth activities that's inside a marketplace ecosystem. So churn is very important. If you are selling a lower ticket item, you're probably going to have a higher churn. If you're selling a higher ticket enterprise kind of software, then you definitely have much lower churn than if you're selling the low ticket item. But overall, while it's important, growth is often much, much more important for you to focus on. So let's dive into some of the ingredients of the multiple. So what goes into the multiple? So the first one is revenue expansion. This is something a lot of SaaS owners just honestly don't think about, especially when they're, maybe a sub $800,000 SaaS business. They usually only have one way to make money off their customers. Now, a revenue expansion can be fantastic. In fact, this is one of the ways a lot of SaaS investors grow their acquisition is they dream up what kind of revenue expansions can they do with the audience. Because remember what I said earlier on churn, selling to a customer that is already your customer is easier than getting a new customer, right? So instead of focusing on churn, these investors are often focusing on revenue expansion. Revenue diversity like this also gives you just a more protected business and is more valuable in a lot of ways because of that. So you should look for ways you can do multiple upsells or downsells or cross sells to your customers. And we've seen this in multiple different ways. Probably the most common would be pricing tiers, where you have pricing plans that offer more features as you go up on that pricing plan. But we've seen it other ways too, where a SaaS might even offer a service of some sort in addition to what they offer in the actual software. So it's worth considering. Next is age. So in most businesses, this is actually quite important, but not so much in SaaS businesses. Age is just not as important of a factor because SaaS businesses can grow so explosively. And if they dominate the industry, then the normal things that would upset, say, an e-commerce business is less likely to upset a SaaS business. So age is just not as important of a factor, but it's still a factor. So keep that in mind. Traffic diversity, this is fairly important. It's similar to revenue expansion. What you're doing here is eliminating what are known as critical points of failure in your business. If you only have one traffic source, say your entire SaaS business is ran by a like a LinkedIn ad, something like that. Like that's where like 98% of your new business is coming from, and LinkedIn bans your account. Well, your SaaS is in a lot of trouble, right? So we want to look at diversifying our traffic source. There's multiple different ways you can do this with ads, with SEO, with social media, all that kind of good stuff. From my perspective personally, and I think Viola would probably agree with me, I think SEO is the best one to diversify into. So say you're running your SaaS business right now and you have a good Facebook ad campaign going, set aside some of your budget to commit to that 6 to 18 months timeline that it's going to take for you to really blow up your SEO or to see if it's a viable marketing strategy. Because the beautiful thing with SEO is, say you did have a competitor that came in who is VC backed and they have a lot of money. They can't just turn on an SEO ad and they outrank you. Now, of course, they could go and do Google AdWords, but in general, it's going to take them time to compete with you on SaaS or with SEO, I mean. And for us personally, like SEO is my background. So Empire Flippers is built off the back of SEO, and that lowers our CAC, our customer acquisition costs, dramatically. And now, what that will allow you to do as you lower your CAC is go more aggressively into these other traffic channels like Facebook ads or LinkedIn ads, and literally outpay your competition to the point where they can't pay for an ad because their CAC is too high because they're focusing all on paid, but you are focusing on that organic strategy as well that brings down your blended CAC. So traffic diversity is super, super important for a business that wants to be defensible and have the highest valuation. Now, all that being said, I don't want to leave on this point where you're thinking like, oh God, I cannot sell my business. I only have one traffic source. The vast majority of businesses we sell only have one traffic source. It is very difficult for a lot of bootstrap entrepreneurs to take the time to well diversify, because it's not just about like turning on the ad, right? You actually have to be good at it too, is the other part of that equation. So if that is you, where you're still a mono channel entrepreneur, totally okay. You can still sell your business. If you want to maximize your exit, definitely look into traffic diversity though. All right, let's go with growth here. So I already talked about this quite a lot, but growth is the biggest needle mover for you when it comes to your multiple. The higher percentage of growth year over year, the better your multiple will be. So this is again why I say focusing on churn, like or not, or sorry, not focusing on churn, focusing on growth. Churn is cool, but growth is much, much better. If your intent is to exit your SaaS business for the largest amount of money, the largest amount of capital in your pocket as possible, growth is what you want to focus on. And one way to get that growth is by focusing on brand. Now, brand, as far as valuations go, is a very tough thing to define. It's a soft, squishy thing that doesn't really have a lot of hard metrics to it. But there are things we can see, things that the buyer will also see of what kind of goodwill you're building with your brand. So, are people talking about you on Reddit, on Quora? Are you in social media groups where people are responding favorably to you? You know, if I put your SaaS brand into a tool like Peak Metrics or Sparktoro or something like that, are good things going to come up? Are people excited about what you built? Now, if you're a small SaaS business, the answer is probably no. And that's okay too. You know, you're not going to get the best multiple in that case, but the investor is going to look at that as a potential huge opportunity that no one knows your brand. We've sold a lot of almost like indie developer SaaS businesses were very, very small, like 30K to 120K. And really the only marketing that SaaS founder ever did was a few posts on Reddit that went semi-viral in their subreddit niche. So the buyer who bought that SaaS business actually loved that fact. Now, obviously, that business is not going to get a huge SaaS valuation, but that investor loved that because they knew marketing and they could just revolutionize the whole business, and they did. I think they probably 5 or 6x that business pretty quickly after acquiring it. So you don't need like the greatest brand in the world to sell, but by having an excellent brand, you're going to get a boost to your multiple. Now, the next one's email list. And this is something I talk a lot about to every business model. I feel like SaaS owners probably have the best grasp on using email marketing, or the best understanding of it, of any business model, because there is something that happens which I think is kind of funny. So I'll get hit up where people will ask me, hey, I have this email list of 50,000 people. How much is that going to grow my valuation? Like, how much extra money am I going to get when I sell my business? And my question is always, well, how much revenue has that email list produce? And their next response will be nothing. I haven't sent out a single email yet. Like, well, in that case, it will help you not at all in your valuation. In fact, it probably will hurt your valuation in this case, because you would have been better off sending them to somewhere where they could buy something, right? Where they could sign up for your SaaS. Now, this is not something I see super commonly in the SaaS world. I do see it in the more greater entrepreneurial world, but it's worth mentioning that your email list is an extremely important part of your valuation, but only if you actually use it. So with email lists, you can get the follow-ups where they come in and they actually buy your SaaS product, right? Or you can re-engage with those who have churned to get them to sign back up. You can use your email list as data for like LinkedIn lookalikes, Facebook lookalikes, all sorts of types of accessory marketing that you can do, of running retarget ads, segmenting your marketing funnel. There's just so much you can do with email marketing that you should really be focusing on it. Sorry, someone just walked into my room. But email lists can really improve your valuation in a dramatic way. But you have to show that it can actually provide revenue if you're going to do it. All right, so let's talk about the golden ratio real quick. And this is a simple concept to understand, but is your lifetime value to your customer acquisition cost. Most investors looking at a SaaS business wants to see this golden ratio of 3 to 1. Now, if your LTV is even higher than 3, that's awesome. You know, that's great. And that's probably a interesting note for an investor. We're like, oh, well, maybe they're not spending enough on ads. Maybe there's an opportunity here where I could spend a little bit more money on ads and bring that, say, 5 to 1 back down to 3 to 1, and that extra growth would be huge for them, right? So this again goes back to the CAC. If you're focusing on SEO as your second traffic channel, or some sort of inbound marketing that makes up a healthy amount of your SaaS signups, then you're going to lower down your CAC and automatically be viewed as more valuable and more attractive to an investor. Once you get above this, like say you were 3.2 or worse, obviously 3.3, the investors are going to be far less interested. So actually tracking your LTV and CAC can be a very helpful metric to see just how healthy of an acquisition you'd be when you're ready to sell. So let's talk about some of the pitfalls to avoid when it comes to selling your business. And this is not by any means all of them. There's a lot more, but these are some of the most common ones I see. So whether you decide, like say you want to sell your business, whether you decide to use us or go private or whatever, this should help you out. So this first one is probably the one I see the most when it comes to SaaS. And this is a concept I call emotional equity. Emotional equity is where is often your very first business you've ever built, or maybe your first one that was really, really successful. And you have this emotional attachment to that business that gives you an outsized view of what your business is actually worth. So you might think this is a $1.5 million business, but a buyer will look at your P&L, your profit and loss statement, see, well, that might be one day, but right now it's a $250,000 business, right? So we want to be careful here and make sure we don't fall into this trap, because it's a really good way for you to kill excellent deals that come your way, because you have this emotional equity. And the reason why we have this is because our business allowed us to travel the world, or give up our commute, allows us to do something that was amazing in our life that we wouldn't have been able to do without this business. And so we have an inflated valuation of what we created, and buyers are going to use a more cruel and cold arithmetic when they're looking at buying what you built. So just keep that in mind. Next one is lifetime or heavily discounted ARR. So lifetime, you see these on a few marketplaces that promote SaaS businesses, where like, pay $50 for lifetime access to this software. And they're often doing it because they want the runway. And this might be something you've done as well. But this is something buyers really dislike. They do not like these lifetime deals, because basically you're adding bloat that they cannot get away from no matter what. There's nothing that they can do to remove this eternal cost that has been hoisted onto the business. If you're going to do some kind of promotion where you're wanting to do a lifetime, it is usually going to be better to do a heavily discounted ARR, because at least that has a finite potential end, right? When a buyer comes in. Now, they don't like that either. Heavily discounted ARR isn't the greatest move either. But if you're still in the startup phase and you need a runway, I would prefer a heavily discounted ARR versus doing lifetime, because lifetime will end up hurting you when it comes to selling your business, however many years it is down the road. Next is transferability issues. And this is something that is just almost an afterthought for a lot of SaaS founders I speak with. So say your payment processor is through PayPal. A lot of smaller SaaS businesses do that. They use that as their merchant gateway. There's a major issue here if you're going to sell your SaaS business, because that PayPal account is not transferable. So you'd have to be giving up your entire PayPal account, whether or not you used it for something else, maybe used in your personal life. This is a common issue, entrepreneurs mixing personal and business bank accounts together, right? So this is a major transferability issue. So in this case, what would happen, say you can't transfer that PayPal account, what we would need you to do is, all right, you need to set up a new merchant processing system that is transferable, get everyone on it, and then wait 6 months to make sure that people actually transferred, right? Because we don't want a buyer buying a business where they have to do something like that and find out like 80% of the people didn't transfer over. So the business has lost almost complete value overnight, right? So this is a major issue to consider of, is my business transferable from the code down to the merchant processing? And the next one is, again, focusing on churn versus growth, which I covered a lot already, so I won't go too deep into it. But growth is often going to be the better bang for your buck when it comes to valuation. The next is expecting a revenue evaluation for a declining business. And this goes back to the emotional equity, where maybe we've watched a little bit too much Silicon Valley, and we think that we should get this insane revenue valuation, even though our business not only is it not growing, but it's actually declining by 10% year over year, or maybe even worse, right? So in those kind of situations, you've got to pretty much accept a profit valuation, which is not the end of the world. You can still get a great valuation with a profit model versus a revenue model. And if your business is declining, say it's one of those businesses you lost passion or focus on, then you're probably actually going to make more money using a profit valuation than absolutely refusing to sell. Because if you have lost passion on it, it's only a matter of time before a competitor removes you as the incumbent in that area, right? There's going to be someone comes up that's going to steal even more of your market share. So it's often better to sell that business rather than not wanting to do it because you don't get a revenue valuation. But last but not the least is understanding your unit economics. So a lot of SaaS buyers, they're willing to pay a high revenue valuation multiple because they're not looking at, like, say they bought your business for, I don't know, 7x, right? They're not saying to themselves, okay, I can't wait to make my money back in 7 years. They're looking at your unit economics plus growth. Like, I'm going to be able to pay this back in like a year and a half, 2 years, if I'm able to put some capital into the inputs, right? Because a lot of times that's what they do. They take what you built, your initial system of leverage, and then they add fuel to the fire that allows them to leverage that system far, far better in ways that you might not have been able to, right? So understanding your unit economics to be able to talk to investors about that kind of stuff is very important, because that's what they are really gauging a lot of times when they're buying, is what kind of return does each sell of each unit really give me. So, with that said, I'll wrap this up with who is actually buying SaaS businesses, because there's far larger world out there than just VCs. So, really quick, SaaS buyers are all over the place, right? There's private equity that comes in. Usually, they'll bring an operator with them because they don't tend to operate the business. But then there's strategic buyers who they'll buy your SaaS business because it makes sense with another business that they own. Maybe you have a SaaS business that helps Amazon FBA sellers in some way, and a agency that is a marketing agency for Amazon sellers will buy up your business because there's strategic synergy there, right? There's also portfolio owners. So these are people who collect SaaS businesses, often in a cash flow play, though they do buy growth too. And they are just building out a giant portfolio of SaaS businesses. That's their like main goal. And the last one is entrepreneurs like you. Often these are people who have sold their business, like I mentioned at the start of this, and now they have capital, because when you sell your business, is usually the largest windfall of capital in your entire life. They will sometimes turn around and start buying SaaS businesses because this is what they know, right? They understand how to make them better. So the moment you sell your business, this is what I want to leave you guys with, is the moment you open up to what I call the doors of possibilities. The doors of possibilities allows you to do things you just couldn't do before. Like I said, this is like life-changing capital for a lot of people, probably the largest amount of capital you've ever gotten. It's going to allow you to supercharge your other projects, perform offline investments if you want. Like we have sellers, they buy real estate free and clear, building out portfolio equities, and of course, tons of cryptocurrency. How could you not buy some Dogecoin when you sell your business, right? Or acquiring profitable businesses. All of these are doors of possibilities that capital opens up for you, that were just simply not open, simply not there for you when you first were building out the business. It's only when you sell. So I always tell people the start of your business is often when you sell your business, for this very reason. So that's pretty much it. I already talked about this, but I do think when you sell your business, this is the best way to diversify, to truly defend your wealth, to create defensible wealth. Because again, most of your net worth is going to be tied up in your business. But yeah, thank you. I hope you guys got a lot of value out of that.
Thank you so much, Greg. I really appreciate it. I think you did a good job outlining the different reasons why you might be thinking about this, and then also the different things that you can be doing. I'm curious on the case, if we do picture the solopreneur or small team, and they're maybe looking to start something new. You said obviously you want to have a growth trajectory when you sell. Is there a case where you would recommend someone to keep the business, let's say another year, work on growth, work on marketing, and then try to sell later for a higher multiple? And when or when not would you recommend that? Or do you think, as you said, sometimes it's still better if you're moving on, move on, burn the bridge, burn the ship, and that's it? Or is there a case where you say like, no, why not push it for a year to get that multiple going?
Yeah, this is a fantastic question. So, like so many things, it depends, right? I think if you've lost focus on it and you really are focusing on something that has a much better growth trajectory, I think it's better to sell right away. Like, yes, you could get a better multiple, but is the opportunity cost of getting that better multiple really worth it versus just
Right.
selling it and focusing on the bigger one, right? Now, if you are still interested in the business, then yeah, if you want to sell it for the highest valuation, timing is not an issue. Like you don't need money right away. I think it
Yeah.
can be a really good move.
But Greg, do you want to give people a final information? Where can they follow you personally? Where can they reach out? What are some good web properties?
Sure. So if you're curious on what your SaaS business is worth, you can check out our valuation tool there. We don't have our new growth tool updated yet on there for SaaS, so it's still using a profit valuation. But in terms of connecting with me, you can connect with me on LinkedIn or Facebook. I write a lot of bad poetry on Facebook, so if you prefer just business, Greg, LinkedIn is usually better. And you can just reach out to me, Greg at EmpireFlippers.com. Usually pretty easy to get a hold of.
Yeah, I really appreciate that. And I really appreciate the level of detail you brought to the presentation today. And so, anyone listening, if any questions arise now, which I know I have many, feel free to pop them in the chat and we're going to keep the conversation going. Thank you, Greg.
Thank you.